The stock market lately, it's felt a bit like being tossed around in a storm, hasn't it?
Uh,
Huge point swings for the Dow, the S&P 500, the Nasdaq, way up one day, then down sharply the next. It can really leave you wondering what's actually going on.
yeah, that feeling of uncertainty is, well, it's understandable. Today, we're going to take a focused look at a specific event, something that just happened with the S&P 500.
Exactly. And our goal with this deep dive is to understand precisely what this event was and, maybe more importantly, what history suggests it might tell us about future stock market returns.
Right.
And here's where it gets really interesting. This particular kind of market move, it's only happened 14 times since 1988, so pretty rare.
It is a relatively infrequent occurrence, yeah, which is why understanding its historical context can be, well, potentially valuable.
We know keeping up with all these market swings can feel like just information overload sometimes.
Totally. So we really aim to just distill the key insights for you.
Okay, so first off, let's just confirm what you've likely been seeing. You're not imagining things. The market has definitely seen some significant volatility recently.
Absolutely. If you look back, say, the 5 weeks leading up to early May 2025, there was considerable movement, especially after the S&P 500 hit that record high back on February 19th.
Yeah, and the S&P 500 and the Dow both dipped into correction territory.
Mm-hmm.
And the Nasdaq, with all those growth stocks, it even slipped into a bear market for a bit.
And April is a particularly wild month. You had the S&P 500 experiencing I think it was the fifth largest two-day percentage drop since 1950.
Fifth largest since 1950. That's huge.
It is. And then, almost right after, it notched its biggest single-day point increase ever recorded.
Just back and forth for massive swings.
Exactly. Substantial shifts in a really short amount of time.
Okay, so what was the main thing driving all this? What kicked off this intense volatility?
Well, the analysis really points to President Trump's newly announced tariff policy as a pretty significant factor. Remember, on April 2nd, he declared that new 10% tariff on goods worldwide.
Yeah, the global tariff.
Yeah, and also floated the idea of higher reciprocal tariffs on countries that run trade deficits with the U.S.
And that initial announcement, that's what triggered that big two-day drop in the S&P 500, right? That was the immediate catalyst.
Correct. The market reacted pretty negatively to the potential broad impact of those tariffs. Uncertainty.
Okay.
But then, just a week later, April 9th, President Trump announced a kind of pause, a 90-day delay on those reciprocal tariffs for, well, everyone except China.
Okay. So that news caused the rebound.
That seems to be what triggered the record single-day gains we saw. It was like a temporary sigh of relief for the market.
So, okay, some temporary relief maybe on some fronts, but it still sounds like there's this this cloud of uncertainty kind of hanging over things, with trade talks ongoing and those reciprocal tariffs still potentially coming back later.
Exactly. That's a big part of it.
Not to mention things like inflation worries and maybe slower economic growth here at home.
Precisely. The market tends to really dislike uncertainty, and there are several interconnected factors feeding into that feeling right now. And, beyond just the tariff news, we should probably also talk about where the market was before all this started, valuation-wise.
Right. The Shiller P/E ratio, that number was looking pretty high, wasn't it?
It was indeed. Back in December 2024, the S&P 500's Shiller P/E hit nearly 39.
Wow, 39.
Yeah. And just for context, the Shiller P/E, it looks at inflation-adjusted earnings over the last 10 years. It's a way to get a kind of longer-term view on how expensive the market is.
Okay.
And what's pretty striking is that historically, looking back like 154 years, during continuous bull markets, that reading near 39, it was the third highest ever observed.
Third highest. And typically when that Shiller number climbs above 30, what does history sort of suggest? It's not like a guaranteed crash warning, but it points towards a greater chance of what...
Exactly. It's not a perfect timing tool, not at all. But the historical data does show that readings above 30 have often come before significant market downturns, losses of 20% or more in the major indexes.
Okay.
So that high valuation was definitely another sort of underlying factor making the market maybe a bit more sensitive.
And it wasn't just about how expensive stocks seemed, was it? Weren't there also some signs the economy itself might be cooling off a bit?
That's right. We got the first quarter GDP numbers, and they actually showed a small contraction, 0.3%. It was the first time the economy had shrunk in, I think, 3 years.
First shrinkage in 3 years.
Yeah. And while the stock market isn't always, perfectly in sync with the economy day to day, a contracting economy can definitely create some headwinds for corporate profits down the line.
Makes sense. And we should probably also mention rising Treasury bond yields. That has ripples everywhere.
Absolutely. When bond yields go up quickly, it can make borrowing more expensive. For consumers, things like mortgages get pricier. For businesses looking to invest, their costs go up too.
Which can slow things down.
Which could potentially slow down economic growth, yeah. So you have this kind of mix. Trade uncertainty, high stock valuations, some worries about the economy itself, plus rising bond yields. All likely playing a role in the market's jumpiness.
Okay, so that's the backdrop. All that turbulence sets the stage for this rare and historic event that the analysis talks about. Because despite all that negativity, the S&P 500 actually managed a pretty impressive comeback, didn't it?
It really did. Despite those big drops we mentioned, the S&P 500 did bounce back pretty decisively from its low point on April 8th.
And how big was this rebound? Can we put some numbers on it?
Yeah, so on a total return basis that includes the dividends, the S&P 500 gained 12.5%.
12.5%.
In just 17 trading sessions, ending on May 1st. That's a very fast, very strong upward move.
Okay, and this is the event that's only happened, 14 times since 1988, this specific kind of bounce?
That's the one.
Tell us more about why this is so interesting historically.
Well, according to Jeff Winiger, he's head of equity strategy at WisdomTree, a gain of 12.5% or more within just a 17-day trading window is, relatively uncommon.
Okay.
His analysis shows that since the start of 1988, there were only 13 other times the S&P 500 rallied that much, that fast. So this recent one makes it the 14th instance.
14 times in, over 35 years?
Exactly. And the key insight here, the reason it's worth looking at, is that historically, when the market pulls off this kind of powerful, quick recovery after some turbulence, it seems to suggest some underlying strength. And it's often been followed by continued positive momentum over the next year or so.
Only 13 other times before this one.
Yeah.
So what happened in those previous cases? What does the data show?
So Winiger looked at data from Refinitiv, tracking the S&P 500's total returns after those prior 13 surges. And what really stands out is what happened about a year later.
Okay, the 1-year mark.
Yeah. In 11 out of those 13 previous times, which is, about 85% of the cases?
85%, yeah, that's high.
In 85% of those instances, the S&P 500 was trading higher 1 year after that rapid bounce occurred.
Wow, an 85% chance, historically speaking, of being higher a year later. That's a really compelling statistic. What about how much higher? What were the gains like?
Good question. On average, across those 11 instances where it was higher, the S&P 500 gained significantly. The average return was 19.6% in the year following those surges.
19.6% average gain.
Yeah. Now, if you compare that to the sort of normal average annualized total return for the S&P 500 since 1988, which is around 11.9%.
Okay, so quite a bit higher than the long-term average.
Significantly higher, yeah. It suggests that these quick, strong rebounds have historically tended to precede periods of above-average returns over the next 12 months.
So for you listening, while this isn't crystal ball stuff, no guarantees.
Absolutely crucial point. As the analysis stresses, no predictive tool is perfect. Past performance is never, ever a guarantee of future results. Right. And it's worth pointing out that 2 times it didn't work where the S&P 500 wasn't higher a year later, those happened during the dot-com bubble.
Okay, so a very specific, maybe unusual period.
A period with its own unique market dynamics, for sure.
Still, though, that historical pattern, that 85% hit rate and the above-average returns, it's a pretty significant data point to think about, isn't it?
It certainly offers a valuable perspective, I think. It kind of reinforces the idea of, trying to maintain a long-term investment view.
Yeah. And
trying to look past some of the short-term noise and volatility in the market. As the author also notes, if you look at rolling 20-year periods, there actually hasn't been any rolling 20-year period in over a century where the S&P 500 didn't end up higher eventually.
A century. That really puts the short-term swings in perspective.
It does. Focus on the horizon.
So the big takeaway here seems to be this recent, really fast, really strong bounce back in the S&P 500. Historically, that's been a pretty positive sign for where the market might head over the next year or so.
That's the core finding, yeah. This deep dive, hopefully, gives you a kind of shortcut to understanding a potentially important market signal, something you might have otherwise missed with all the day-to-day headlines.
Right. So as you think about your own long-term investment strategy, maybe consider how this historical pattern fits into your thinking. But always remember the market's full of complexities and, uncertainty is just part of the game.
Absolutely.
And maybe it leads to another question worth pondering. What other historical patterns or indicators out there might offer some useful insights into our current economic landscape? That's definitely something to maybe mull over.